you cannot share with the back of the house or the non-tipped people the tips that come into the restaurant.
And nor the manager.
Nor the manager, nor the owner.
Whoa, not even the owner?
Not the owner.
Okay, no, that was a joke, people. Not the owner.
This episode is brought to you by Halcyon Eco.
All right, we're back here with Peter from Halcyon Eco, the founder and CEO, and I've got a situation with a customer that is very, how do you want to say, green certified, or it's very important to them to be environmentally friendly, and they do a lot of PR around that in their restaurant, making sure their consumers know that, we're here to try to make sure that the environment is better long term. How does your product tie into that for somebody that's trying to express that type of message out to their consumers?
I suppose you have to go back to the environmental issues associated with vegetable oil, and I'll quickly list them out. You have deforestation, you have indigenous species, you have animals being lost, you have the water being polluted. There's a raft, a simple stat now is that the Amazon forest now is being burnt to create farming agriculture for vegetable oil. The Amazon forest now, every time it's burnt, is emitting more carbon now than it's taking in. That's a crazy fact. These were the lungs of the planet.
Yeah.
Now they're a bad smoker.
Wow.
Essentially is wow. What they are. We are on a road now to destruction that we cannot reverse. We can just slow it down. We can't reverse it. So for the environmental issue guy, if he understands what vegetable oil production is doing globally, and you have a machine and on your counter is a little ticker explaining to him how much carbon you're saving, now you're getting a massive tick box, because he's naturally going to inquire as to what is this that you're saving. It says, I've saved 1 kg of carbon, 2, 3, and it'll tick up all the time. So now it becomes a topic of conversation. And now for your environmental customer, where it's very important for them, you have done something that's very small, but very, very important to them.
No, that's amazing. If you want to find out more about the Halcyon Eco, please go to Restauranttopia.com and check it out. This is Restauranttopia.
Welcome back to Restauranttopia. We had a great episode with Jamie Romano from J&R Accounting here. We're going to talk all things the Big Beautiful Bill. It's going to be really well done, because this is take 2, because I forgot to hit record. I got Anthony Hamilton here with Jamie.
What's up, man?
How you doing?
Feeling?
All right. Jamie, how's it going?
It's going great. Thanks for having me on.
I mean, you never heard that saying before. All right. So, Jamie, our audience, local independent restaurateurs, what do they need to know about the Big Beautiful Bill?
So the first thing they need to know is about the Trump tax cuts from previously in 2017. Those have all been extended, and not only have they been extended, but they've been made permanent, so they're not going away. Those were all set to expire at the end of 2025. So the lower tax brackets, the qualified business income deduction, the Section 179 and bonus depreciation, all those things that have helped restaurant owners in the past when they've wanted to do build-outs, acquire restaurants, etc., those are going to be permanent. So that's been great. Nice little piece of legislation that's going to be pro-business. The second piece that is not directly related to business but will affect business owners is that SALT deduction. So that's your state and local taxes. Previously, it had been limited to $10,000. And when you're in Ohio and you have property tax, state tax, city tax where you work or where your business is located, then a city tax potentially where you reside, many owners were hitting that $10,000 limit real quick and not getting a deduction for that excess. So that's been bumped up to $40,000, meaning that you're now going to be able to take up to $40,000 going forward.
Nice.
Huge increase. Great for a lot of people that are in high tax states like Ohio. The next piece doesn't affect business owners directly on their own taxes, but it's very important that they understand what's coming, because you're probably going to get questions about it. You're going to have to deal with answering employees directly, and that's going to be the no tax on tips, no tax on overtime. So let's start with tips.
This is amazing to me as far as the benefit for the employee, but also, do you think there's going to be and again, we all know the industry, a push to actually report the actual number?
Well, that's what they're going for, because the theory is if you're not going to pay tax on it, why not report it?
Yeah.
So, and to be clear, it is only applies to the employee that is going to get this deduction. So if maybe previously the employee was not claiming their cash tips, that was saving them tax money, but it was also saving the employer because the employer is not paying FICA taxes on it. So they're not paying Social Security, they're not paying Medicare, they're not paying state employment, they're not paying
On
workers'
tip.
comp on the tips,
So-
which
I
they
didn't know that.
they do on the reported ones.
Oh, I did not know that.
So
yeah, but everybody claims 100% of their cash tips, Brian.
I'm just saying, in a theoretical world where the matrix is broken and people aren't recording all of their tips, if that were to happen, I'm not saying it does, but hypothetically.
So it will, although give a deduction to those employees, they may see a little tax increase because if people are willing to report more of their tips, now the employer is going to pay tax on those tips
Interesting.
on the employer tax side.
That's fascinating. I did not realize that the employer has to pay a tax.
Oh yeah, no, they make sure that they
Wow.
yeah.
Okay.
So the rule is and there's going to be some caveats to this, meaning the first 25,000 of tips not taxable. So it's not all tips. So if you have a high working server,
Okay.
they make 40,000 in tips. It's not like all 40,000 are not taxable, but that first 25 are not. There are some exclusions though when it comes to income. So it's 150,000 single, 300,000 filing jointly. So if let's say a server bartender was married, their spouse is maybe a doctor or a lawyer or something, they make big money. They could be a case where they do not get that deduction because it is phased out. If
that seems far-fetched on the surface, but I know of quite a few people who go out to work to generate a little walking around money and to socialize because otherwise they're stay-at-home spouses.
Exactly.
And
So
it happens quite a bit.
So there will be some instances, although it will be rare, where the tip deduction will not apply to an employee who got tips. But that first 25,000 is not going to be taxed. It's easy to take because it's going to be on the W-2. So it's a real easy number to find. There's no big issue. The problem is going to be if your employee hears this and says, hey, there's no tax on tips. And then the very next week, their check is the same. And they're like, hey, you're doing this wrong. You're not doing it wrong. So because this is happening mid-year, what the government said is we're not going to change the tax tables.
Okay.
They're going to stay the exact same for 2025. They're going to get this deduction with their return that they're going to file next year. So they're going to get a larger return next year. So there's going to be no change to their paycheck. So that may raise some questions. Might have to answer that. Now going forward in 2026, they are going to change.
There's going to be a
The
million
tax
questions for this, and we'll put a bunch of answers in the show notes, and we'll work with Jamie on this. But like, this is a nightmare for the employer.
It can be. So it's going to
Especially if they're doing their own taxes, right?
Well, not if they're doing their own taxes. Just all of a sudden you become the CPA for every single one of your employees. Like just be like I become the lawyer for every one of our employees. Full disclaimer, I'm not. But like, everyone asks you the question, and they're expecting to have an answer.
For real, yeah. I mean, I think there's a problem with any sort of legislation of this bandwidth is it's hard to decipher. I mean, hell, we're what we consider to be pretty well versed in the industry, and we bring Jamie on to help translate this for us.
Yeah.
So it can be great. It may actually really help get people maybe back in the industry because nothing's better than not paying tax. So hopefully it helps because the hospitality has struggled in terms of retaining employees both in back of the house, front of the house. So it could be a big win there. Now, I'm sure there will be all sorts of, let's call them nefarious characters who try to maybe take advantage of this.
Never.
Hey, can you say I made more tips instead of hourly wage? And, we won't necessarily delve into that, but it is going to be a boon for your employees that are in the front of the house.
And is this for all tipped employees? So whether you're exempt or non-exempt?
So it is not going to apply, tips in general. So maybe we should back up and make sure everyone's complying with tips. So
I love this.
There are a couple things that you need to keep in mind. Is if you have tipped employees, which most full-service restaurants are going to have tipped employees that make a tipped wage, that's going to be half the minimum wage in Ohio, and then you have back of the house employees making normal wage, you cannot share with the back of the house or the non-tipped people the tips that come into the restaurant. And
nor the manager.
Nor the manager, nor the owner.
Whoa, not even the owner?
Not the owner.
Okay, no, that was a joke, people. Not the owner.
So it is very important, as much as maybe we'd like to, help out and everybody's working in this together. If you have tipped employees, those cannot be shared. Now, I have not seen this happen, but if you happen to be a restaurant that is paying everyone above full minimum wage, you can share tips however you want. In terms of with employees, still no owner, still no manager.
Yeah.
And that's a Department of Labor thing.
Interesting. I didn't know that. So if you're not taking a tip credit, you can then determine how the tips are allocated to other employees.
You could.
So we've talked about tip pooling quite a bit on the show, and we've talked about certain restaurants that have gotten in trouble because the ownership or management starts mandating how the tips are allocated, but they still take the tip credit. Always results in a huge lawsuit.
Yeah. So
every time.
It's one of those things where as much as you want to say, hey, we're one team, we should all share in the tips, if there's tipped employees, you can't do it.
So as to the big, beautiful bill, is there a difference between those buckets of, categories, so to speak?
There is not. The only thing that you may see is, especially if the kitchen staff, is a little bit educated on it, and they're like, hey, why are their wages going to be exempt from tax? And then I'm back in this hot kitchen slaving over it, and I have to pay full tax. Yeah. Not necessarily your fault as the restaurant owner, but there could be some grief.
It's a conversation. I
didn't even think about that. You just hit me with a ton of bricks there. Yeah. So we're driving the wedge between front of the house and back of the house even more. All of a sudden, everybody wants to be a server.
Because let's be honest, there already is kind of that wedge where you have
episodes on it,
where you have cooks who are upset. Hey, I'm doing all the work. They're literally taking it from point A to point B, and they're making more than me.
Which is also a short-sighted approach because I've done both jobs. They're both very, very hard, just in different ways. One job you stay cleaner physically, but you leave dirty emotionally because you get right. Yeah. And whereas the cooks get dirty physically, they typically have a pretty good time back there in the heat and the stress. But they can say what they want to who they want, right? So
exactly.
But both jobs are equally hard, I would say. But getting your employees to understand and agree with that is much more than challenging.
No question. And now the second piece of legislation does apply potentially to back of the house, and that's the overtime rule.
Oh.
So there is going to be a deduction available as well for overtime. So it's going to be $12,500 up to $12,500. So again, if you go over 12.5 and let's say you had 20,000 overtime, you only get the 12.5 deduction. Similar in terms of the income limits. So it's 150,000 single, 300,000 married filing jointly. So same thing. If somebody is married and making a ton of wages, or maybe their wages are high enough that they're above that threshold, you won't get the deduction. Here's the problem. That's going to be the question. They don't yet know how they're going to report that. Meaning, everyone who has payroll should be keeping track of overtime. The thing is that it's not reported anywhere, meaning all your wages are just lumped into one bucket if you're an hourly employee. There is no, hey, they made this much in their normal wages, they made this much in overtime on a W-2. So they're going to have to figure out, unlike tips, which are reported separately on the W-2, they're going to have to figure out in a relatively short amount of time.
Yeah, it's going to have to be reported on W-2, right?
Yeah, it has to be, because there has to be a mechanism for the employee to know what their tips are. But even just as important, there has to be a way for the IRS to verify that is accurate data.
I will say, if there's no information on the W-2 in 2025, every single employee will have $12,500 of overtime.
Yeah, I think that's a safe bet. Now, so to clarify that, though, is it's very similar to the front of the house notion, whereas the employer doesn't get any breaks on taxation from the overtime. They're employees. So only the employees get the breaks. So because it would be nice if there was no premium tax on overtime for employers, because then we could allow employees to go into overtime and hence mitigate some of the staff shortages that we deal with, because as you know, margins are slim. Overtime's the dirtiest word we have, but yet we're short staffed, so we have to allow some. But boy, would it be some relief.
but I love it. To something Jamie alluded to earlier is, are we going to pull people out of the Uber and pull people out of other industries back into the restaurant industry? into industries, hospitality, which are, have potential for overtime and a lot of tips.
Yeah, so it could be great for the employee. You may get some questions about it because same thing. If they're used to working 40 hours plus 5 hours of overtime, they hear this on TV. Oh, by the way, overtime not taxed anymore. Their paycheck, they see no change with the withholdings.
Right.
They think you, the employer, are doing something. You're not. Same situation. They tax tables for 25 because it's happening mid-year. They didn't want to screw things up, so those are staying the exact same. They're just going to get a bigger refund when they file.
Sure.
Okay.
I think that was a huge misconception going into this, but it sounds like they're going to change it for 2026.
2026, new tax tables.
Yeah.
I don't yet know how they're going to incorporate that because while tips are separate, are they going to have overtime be separate as well on the tax table? Because with the tips, it's a little bit easier to do. With overtime, you're going to have a big issue where you're going to have somebody who's maybe working a set number of hours, but you're saying, hey, I'm going to pay you $1,000 a week. Well, previously you had already incorporated, okay, you're going to work 45 hours. Well, now you're going to have to separate those two things, show it maybe separately, and so that they can get that tax deduction. And then are you going to have people who are maybe managers now wanting to go to hourly?
Yeah.
Because they're saying, hey, if we just show me as hourly instead of as a salaried manager, I could save money on my taxes. And so then you have to go through that process, and this may be the biggest negative at all. If you have a manager who's working a lot of hours, maybe they're working 50, 55 hours, and then you compute what that would be 40 hours plus the whatever overtime hours they're working at time and a half, they may be surprised at what that works out to as an hourly wage.
I thought that's where you're going with this. Like when they see the hourly wage, it's...
And they go, hey, the guy I'm training is making almost the exact same money I'm doing. I've been here 10 years.
Mm-hmm.
Yeah, per hour.
Per hour.
I have I've showed that spreadsheet to multiple employers that I've worked for over the years as a sous chef specifically, because you're kind of in that middling ground to where you take a dip and pay per hour because your hours go up like exponentially, and then you meet the next threshold, you make real money, right? But that kind of purgatory you're in as a sous chef, I've had to sit down with owners, I think on 3 different occasions with a spreadsheet and say, these are what my saute cooks make per hour. This is what I make per hour. Can you fix this, please? Yeah, I've had to have those conversations. So you're absolutely not wrong. That is.
And so that may be coming up soon because everyone's going to be looking at, okay, how can I take advantage of this? How can I make sure that if there's 12.5 available to me, that I make sure I don't get taxed on that money?
Now, they mentioned anything else about the salary threshold for overtime employees? Because I think that could come into play with this as well.
So Department of Labor, sets the whole who's exempt, who's not exempt. So I believe you may see that change as well.
Yeah.
So because and that's something they look at all the time, independent of the IRS and tax bills, because they do want to make sure that you're not having people who are at a lower pay rate or lower pay scale as listed as a manager, so that you can work them to death at low rates.
There was a local restaurateur, very well known, that had his cooks were chef de parties. They managed their own station. They placed their own orders, took their own inventory, so they managed that particular area. And they were able to get away with a paltry salary and a lot of hours worked based on that. It caught up to them, though, unfortunately.
Yeah. And that's, best practices are, happier employees are going to lead to more a happier life running your restaurant.
Simply put.
I would agree.
Yeah, pretty profound.
All right. So anything else in the Big Beautiful Bill?
Those are the things I think are most important for restaurateurs. There are some other things related like to Social Security and other areas that I don't think restaurateurs are necessarily going to be all that excited to learn.
No, we picked this industry. We're going to work forever. There's no retirement.
But the nice thing is with the that I don't think a lot of people realized is that a lot of the Trump tax cuts of 2017 were all set to expire.
Yeah.
And so by having those re-upped,
huge,
because I don't know that many people were really even talking about it before the bill. And so, including myself. And so it could have been a situation where people are used to paying, hey, I make this much money, this is how much tax I pay. And then the following year, meaning for 2026, when they would file in 2027, they would get a big shock.
Yeah.
So it is nice that people tend to, once they get used to a certain way, a certain tax, they tend to not want it to go up. And so the fact that they made this all permanent means that barring some sort of new legislation, that's not going to happen.
Jamie, thanks for being on today. I have one quick question, maybe not a quick answer, but at J&R Accounting, you almost exclusively do restaurants and restaurateurs, tax returns. What are 2 or 3 things that you're seeing that people are missing with their standard H&R Block accountant?
Sure. One thing I've noticed, and I didn't even think this would be possible, just because it's been around so long, and it's what Anthony alluded to, which is the FICA tip credit.
Okay.
So you as an employer, yes, you pay FICA taxes on the tips, but as long as the employee makes above minimum wage during their time working, you actually get a credit on your if you're a pass-through entity, it flows through to you, or on the business tax return itself for that Social Security and Medicare tax paid.
So just a clarification for the audience. I know the answer to this, so I don't know the answer to this. When you say above minimum wage, you mean
that
with the tip and the wage, or the wage actually has
meaning
to
that you're paying people half minimum wage now in Ohio because of the tipped wage.
Yeah.
If for some reason, let's say there was a snowstorm and nobody came in, and so all their hours that they worked were below minimum wage with their tips, you are not going to get credit for that.
Okay, so it's the combination
yes.
of the two.
Seasonal restaurants need to be aware of that too. Like if you're on a lake in Ohio, where in wintertime you're doing 3 covers a day. So Jamie, real quick, what are any effective dates we got to worry about here from an ownership standpoint or operation standpoint?
So everything is already taking place, meaning that it's already happening. The only thing that business owners are going to have to know is that the tax tables switch next year. So if somebody mentions it, it's not going to happen until next year. If you have a payroll company, they're already aware. So they're already taking steps to make sure that things are going to happen correctly on their end. And unfortunately, we don't even know what they're going to do with the overtime. So you can't yet know, okay, on the W-2, it's going to be in this box. And so we know to tell employees, okay, when you go to H&R Block, or a lot of people do it themselves, make sure that you include this box number so that you get the credit for it. But we don't know on the overtime where it's going to be.
I can only imagine this is good for people of your profession, right? Because those
This
operators,
is a job creator.
Yeah, those operators that were doing their own taxes should probably stop doing their own taxes
and their own payroll.
Yeah, for sure. So, what do you look out for? Like if you're vetting a new accountant or you're looking for an accountant for the first time, what would you think they should be actively reviewing? What kind of verbiage should they be saying? I mean, is this something you could just tell instinctually, or is there certain keywords or components that you're looking out for?
I would say if it's a business owner, I would definitely recommend that you go to a firm that does a lot of whatever your business is. So if you're at a restaurant, there's not just our firm, but there's a great firm, BTO, in Northeast Ohio that does kind of a specialization in restaurant accounting. It's very important because I've seen so many times, and I didn't know it was possible to miss that tip credit. Yeah. Meaning there are businesses out there that could be getting $5,000, $10,000, $15,000 tax credits, and their CPA
credit, just not deduction,
not a deduction. This is
credit.
money taken right off your tax.
So instead of owing $15,000, you owe nothing, or you could even potentially get money back.
And I've seen it so many times, especially recently.
Okay.
So that's something that, for whatever reason, they're missing. If I was a restaurateur, though, I probably wouldn't be as focused on the tax piece, because hopefully you have a competent CPA. I'd be focused on the 2 things that we've seen just wild fluctuations with, especially since the pandemic, and that's your cost of goods and your labor. I know very few restaurants who are up in terms of throughput of sales items sold, meaning they may be up in sales, but that's because they've increased their prices. They're not actually selling more burgers, more tacos, more ribs. So when you're doing that, and then also you have the increase in your cost of goods and then cost of labor, it can be very difficult to make more money.
Yeah.
You don't say.
Yeah. If you had a restaurant that does 1-2 in 2019 and you're doing 1-2 today, you are not selling
It's a
as
problem.
much food, and you're not making as much money.
No, because the cost of labor has jumped, the cost of goods has gone up. So, and I would say the restaurant industry in general, the past year, 2 years, it's been tougher. So
It's
economically, a lot
softened.
of instability. Economically, you kind of came off that high when all that money was flowing around from the pandemic, and it has definitely weeded out a lot of restaurateurs who have unfortunately either had to sell, go out of business, whatever.
Yeah.
So you talked about acquisitions earlier, and we didn't really dive into that. Is there anything revolving around acquisitions or benefits to maybe even sourcing finance or income through low interest loans or expansion benefits or anything of that nature?
So with the bonus depreciation and Section 179 available now at their expanded levels, you can potentially really, if you're acquiring a restaurant, take a big deduction. So you can get that depreciation of any of the equipment assets really fast. But I would like to mention if you're selling, as important as the selling price that you're going to get, it's going to be the allocation of your assets as the seller. And the reason why that's so important is because there are different tax rates to what you're selling. Meaning, if you're selling equipment versus if you're selling goodwill of the business, which is basically just the value above the value of the equipment, it's taxed differently. So goodwill could be at capital gains rates, which are lower than ordinary income rates. The equipment, you actually pay recapture or ordinary income on
Yikes.
the difference between the basis and what you're selling. So I would advise, if you can, make sure that you're discussing as much the price, the allocation with the buyer. Because as much as you can shove towards goodwill as opposed to the equipment, you will benefit tax-wise. And another nice piece about it is that a lot of restaurateurs find that they have to, because there are so few banks out there willing to loan money for single unit restaurants for acquisitions, they have to be the bank. And so they end up financing it. So you can run into a trap where if you allocate it all towards equipment and nothing towards goodwill, and you're financing it over 5 years, you actually end up paying tax year one on the entire value because it's allocated to equipment, which you cannot spread out. As opposed to if you were able to allocate it to goodwill, you pay tax as you receive the monies. So that's kind of a topic that really a lot of restaurateurs, I wish I would talk to them before they want to sell, because that's just as important. They tend to always be focused on what am I going to get in terms of the dollar. But if you allocate it correctly, and especially if you're allocating it over time to the goodwill, you can pay much, much lower tax rates. And nobody here is working for the IRS. So let's pay as little tax as possible, and it can help out the buyer as well, because now you're taking payment over time. They're not trying to get some sort of terrible loan or credit cards or whatever, so that they can actually be successful as your buyer.
I think that's so important. And Jamie and I, on the professional side, see these deals, and that's part of my due diligence list now, and have the form in there. What's the form called?
8594. So that's where both the buyer and seller, you're supposed to, with your final return as the seller and then as your initial return as the buyer, file this form, because the IRS wants to make sure, hey, they're allocating this much to goodwill, this much to assets, this much to inventory. It's supposed to be the same. So you don't want the buyer allocating it all to equipment and then the seller allocating it all to goodwill. So they're supposed to concurrently file the exact same form.
And in my deal audits now, that is the form that we have as part of the deal docs, because April comes along the following year, and now you got to find this person. They're on a beach somewhere, and now you got to match it up, and their accountant doesn't know it even exists. And so it's so important that you have a good attorney, have a good accountant when you're doing these deals, but also thinking about these nuances of deals that can have huge consequences financially.
For sure. And Jamie, to wrap up my end of it, where do you go to get unbiased, unslanted information on this bill? Because we know we're in a political hotbed, right? So
That's a good
everybody's serving an agenda.
I'm not familiar.
I have seen some great information come from my own research from accounting firms and from law firms.
Gotcha.
Where all they're giving you the Walter Cronkite version of it.
Yeah.
I miss him.
I'm just giving you the information. I'm not giving you a slant of this is good, this is bad. I would definitely hit up either your CPA or if you don't have one, you're welcome to reach out to me as well.
Hey.
There you go.
But also the websites of various accounting journals and then law firms have done a nice job.
We'll put a bunch of stuff in the show notes. Anthony has his amazing newsletter that he'll put some of Jamie's content in. Definitely look at this. Again, whether the policy is good, bad, indifferent, it doesn't matter. It's how is it going to affect you and your restaurant and your operations and your employees. So we really appreciate Jamie being on today. This is super valuable, super relevant for the new Big Beautiful Bill. And you got anything, Anthony?
Yeah, I couldn't do it without you, Jamie. Thank you.
No,
I would have fumbled the whole thing.
No, I couldn't even spell Big Beautiful Bill. Like that's a mouthful. Like I love it. Is it one word?
It is multiple words.
Okay.
Yeah, glad we got that cleared up. I was concerned too. I'm glad you.
You have to say it with some vigor, though. You got to really deliver it.
Yeah, for sure. Well, appreciate it very much, man. Thank you.
Thank you. Thanks, guys.